Mohit Gang, co-founder and CEO of Moneyfront. Thank you for joining us here on News 9, Mohit. And I mean, the overall setup as far as India is concerned, it's looking positive. Domestic use, I mean, the data that's coming out, it's phenomenal. The GDP data, the PMI data, inflation data, whatever. But from a global perspective, we are kind of in that inflection point. I mean, oil prices, they are at a 5-month high. The bond yields, they are back at 4.3% levels, and the dollar index has clawed back above 105 mark. How much of that is a threat to the bull run that we are currently on?
So, look, honestly, I think, Suyash, there are mixed indications from the US data which has come out. The PMI data came out very strong, honestly, and the market wasn't anticipating that. Market was rather expecting a weaker data, which kind of lends credibility to the expectation of a rate cut. But a stronger PMI data dents the market's hope that a rate cut is coming soon, and hence the shoot up in bond yields. And that's not just the 10-year bond yield in US across the spectrum, which is the 2-year, 5-year, 10-year, 30-year, all the bond yields shot up by almost 12 to 15 odd bips. And even the dollar index shot past 105. And both of these are not great signs per se for global markets and specifically for Indian markets, right? But my sense is, I think the subcomponents of PMI data honestly are a little more favorable, and I would expect the bond yields in US to ease off from these levels. The commentary from Powell was kind of dovish, and I think there are mixed signals. As I said, market is not exactly able to gauge the magnitude and the when exactly to anticipate the rate cuts. But my sense is we will have a rate cut cycle starting pretty soon in US, and that should ease off the bond yields. If not very soon, my sense is in a reasonable time frame, we should see the bond yields easing off in US. Coming back to home, I think Indian markets are showing robust signs of recovery post that small correction in mid and small caps, which we saw last month. I think the bounce back in the market has been equally ferocious. And today, I think it's only a cool off day. People are just positioning their bets, and I think it's more as a consolidation kind of a thing. I think all the trends and all the indications in the domestic market continue to remain extremely bullish. We saw the GST data coming in yesterday, which was a shocker data again, and it's the second highest mop up ever, right? So all the data points, as you rightly mentioned out, are very promising, and I continue to see bullish trends across the domestic market for the time being.
All right, and Mohit, it's kind of interesting, uh, what's playing out in the US, because one would imagine that a better than expected manufacturing data would be good for the markets, but the markets reacted negatively. Basically, good news is bad news for the markets right now. And I mean, do you think we are playing, or we are paying a lot of attention to this day-to-day activity, because it looks like Mr. Powell is pretty clear. I mean, the last 2 times he spoke, he sounds very dovish. He's pretty much sure that there will be 3 rate cuts down the road, at least in this calendar year. What's your, outlook on this? Are we paying too much attention to everything that Mr. Powell or Mr. Das has to say?
Honestly, Suyash, I think even I found it very confounding that good news is taken as bad news, and sometimes bad news is taken as good news, just because market is too focused on the rate cut cycle and when is it starting. I would still go by what the Fed said in the last meeting, and I think. My sense is we will see those 3 rate cuts coming, which the Fed chair indicated in the last Fed meet. I honestly don't see any big reason right now, just because of one PMI data. US economy continues to remain strong. US inflation data also continues to remain a little hot. But my sense is the Fed is anticipating all that and has kind of projected or taken everything into cognizance. So I would still stand by that 3 rate cut projection from the Fed, and honestly, there's no reason as of now to doubt that.
All right, and one final question from me before I hand it over to Amit. A popular strategy that emerged post-COVID was buy India and sell China among foreign institutional investors. I mean, the data that is coming out sees we are at somewhat of an inflection point over there, because China, again, India, we are, pretty much twice as expensive as China at current levels. India's PE is at about 20x of 12 month forward PE is 20x, whereas in China it's about 9.6. Do you see, because that perhaps playing out into foreign institutional inflows, because they only had started picking up or buying Indian equities just now?
Look, Suyash, honestly, I think there is no two doubts that Chinese market is looking extremely tempting and attracting from a pure valuation perspective. Look, an economy of the size of China, even if it grows at, let's say, it's grown 4.5% last financial year, and this year it's projected to grow at 4.1%. That's not a bad growth number for economy of that size and scale, right? And you cannot, for whatever reasons said and done, you cannot like really take the Chinese economy lightly. No foreign institutional investor will do that. There could be some political reasons, the rift with US recently, and some geopolitical reasons, or just the close nature of Chinese economy, which kind of dents some hope for the FIIs. But just the valuation part is very, very attractive and very tempting. Honestly, I think Chinese economy hasn't quoted that cheap on valuations ever, but for four occasions. And in all those four occasions, Suyash, in a matter of 3 weeks to around 26 odd weeks, the Chinese economy bounced back by almost 50 odd percent, right? So data strongly suggests what do you say, a very attractive Chinese economy. Having said which, India's story is growing robust. The economy is growing. The market is trying to latch up on the China plus one kind of narrative, and we are seeing some amount of traction on those grounds. We are seeing some manufacturing activity moving to India. The iPhone manufacturing, some bit of semiconductors. We are now trying some small components and chips here and there. Look, I think it will take India a while for the entire narrative to shift, but even a small drop moving to India will mean a lot of boost to the Indian economy. I don't think so. The Chinese investors are moving lock, stock, and barrel to India, but incremental flow to some extent, even if that moves to India, I think it will be a great story for India. But honestly said and done, from a foreign investor's perspective, China market looks extremely tempting.
Good morning, Mohit. Now, while the Indian markets were slightly muted yesterday, there was the nifty PSU which jumped almost 1%, and this was fired by the public sector unit banks. Led, whether it was SBI, Bank of Baroda, all of them rallied yesterday. Analysts believe probably because of the benign credit environment, the asset quality of these banks took a surge, and that is why the stocks rose. What is your take on that? And two, the big two, which have not rallied that much in the last 1 year, that is Bank of Baroda and SBI. Do you think it is time for the investors to watch these two, because the others have given some over 100% gains? The table shows it. Is it time that these two big ones, Bank of Baroda and SBI, are the ones that the investors should be watching more than the others?
Perfect. Thank you so much, Amit. Honestly, I think that's one tempting question which everyone is trying to answer in the market. There is no two doubts that private banking sector looks extremely attractive as a pack. But even the PSU banks, honestly, gone are those days when we used to compare PSU banks on the quality of management, NPAs, and let's say some government intervention and those things. I think those all those worries have been assuaged to a very, very large extent. And I think there is no reason why a PSU bank today should quote at a huge discount as compared to a private sector peer, right? So even if today, even after that kind of a rally, if you look at PSU banks and check their trading multiples vis-a-vis the private sector peers, the PSU banks relatively are quoting almost 20% or 30% cheaper than the private sector banking peers on the valuation multiples, right? And with the kind of earnings which is projected for FY25 and FY26, I think most of these banks, the bigger names especially, will be quoting at 1.5 times book on a forward FY25, FY26 basis, right? Which is a very, very tempting multiple. And I don't think so these banks should be now discounted by that big a factor just given the management quality. Even the management quality has dramatically improved, the NPS story has improved, and the margins are obviously ever improving, right? In the pack, obviously SBI and Bank of Baroda are the largest names in the space and remain the most attractive to me, honestly. I think on the valuation perspective, and even if looking at the performance, these two are the ones which are yet to catch up. My sense is, I think these are great bets for patient investors. If you have patience of 2 to 3 years, I think these will be extremely rewarding stories. Bank of Baroda, to some extent, has been dented by some digital uh, things which RBI has pointed out time and again. Their app was closed on onboarding new clients and so on and so forth. I think that's one of the reasons why the bank hasn't done as well as other peers. But to my mind, I think SBI and Bank of Baroda are two banks to watch out for next 2 years kind of story.
All right, SBI and Bank of Baroda, the two banks to watch out for. That's the word coming in from Mohit Gang. Sir, appreciate your time and your thoughts. Thank you for joining us here on News 9.